used to be a tax shelter loophole that allowed taxpayers to pay zero taxes by using real estate to offset W-2 income. Congress caught on to this and closed this loophole years ago. That's why so many taxpayers currently have a lot of passive activity losses that they are struggling to use. When I was an IRS auditor, we would aggressively scrutinize real estate activities to make sure that taxpayers weren't falsely trying to offset their W-2 income against their real estate losses. So your real focus as a real estate investor should be on navigating the passive activity loss rules or the passive activity loss limitations, because offsetting real estate losses against W-2 income really isn't that easy to do. Today we are going to take a look at some strategies that you can consider as you try to manage your passive activity losses. Before we get into that though, I'm going to go through and explain passive activity losses, and then we will look at the limited number of ways that you can offset your real estate losses against your W-2 income and possibly pay zero taxes. Hopefully this video will give you some ideas to present to your tax advisor so you can discuss solutions for your individual situation. Although this video is not official advice, feel free to ask me a question in the comments section. When most people hear the term passive activity losses, they think of real estate, but other activities fall under the passive loss limitations as well. You can also have passive activity losses from a business such as equipment leasing, or by not materially participating in a trust, a limited partnership, S corporation, limited liability company, personal service corporation, closely held corporation, or a sole proprietorship. In a nutshell, passive income and losses come from activities in which you don't materially participate, and any income or loss from rental activities, regardless of how much you participate. There are 3 ways that you can offset your passive activity losses. You can offset passive activity losses against passive activity income, sell your rental real estate or activity at a gain, or totally dispose of the real estate activity. Passive activity losses cannot offset passive investment income. Now, there is a way for real estate investors to use a portion of their passive activity losses to offset W-2 and other non-passive income. If you have a greater than 10% interest in a rental real estate activity, you only have to actively participate in the activity to use a portion of your losses. Active participation relates only to the real estate industry. Active activities are things such as making management decisions, hiring and firing employees, making tenant selections, arranging for repairs, collecting rent, approving expenditures, or performing services for the business. Simply ratifying decisions made by a manager or a management company does not count as active participation. You have to be the person actually making the decisions. So if you actively participate, you will qualify for a special allowance that is sometimes called the mom and pop exception. If your modified adjusted gross income on your 1040 federal tax return is under $100,000 or $50,000 if you're married filing separately, you will be able to offset $25,000 of passive activity losses against your W-2 or other non-passive income. For income over $100,000 up to $150,000 or over $50,000 to $75,000 for married filing separately, the $25,000 will be decreased. If your modified adjusted gross income is at or above the limits of $75,000 or $150,000, you won't be able to offset any of the non-passive income on your 1040 federal tax return. If you're married filing a separate return and lived apart from your spouse for the entire tax year, your special allowance can't be more than $12,500. If you live with your spouse at any time during the year and you are filing a separate return, you cannot use the special allowance. Some other ways that you can possibly offset your passive activity losses against non-passive income, such as your W-2 wages, are A, have a self-rental situation, B, group your rental activity or other passive activity with non-passive activities, C, have an average rental period of less than 7 days, D, have an average rental period of no more than 30 days and offer significant other services, E, materially participate in a business that is not a real estate activity, F, become a real estate professional and materially participate in a real estate activity, G, sell your interest in a passive activity. You have self-rental income when you materially participate in an operating business and the real estate or equipment that is rented to the operating business is owned by you or your spouse. If you want to somewhat circumvent the passive activity loss limitations and offset any rental income or losses against the operating business, you have to make sure that you set up your business correctly. Please keep in mind that you won't be able to offset self-rental income with passive losses from other activities outside of your operating business. So first, you must have the same ownership percentage in both the operating business and the rental activity. Next, the rental activity and the operations activity have to be legally under the same entity, or you have to make an election to group the rental activity with the operations activity. You can only make an election to group the activities in the initial tax year when you report the activities. You will have to attach a formal statement to your tax return. As an example of how this would work, let's say that you are a dog groomer and you own 100% of the dog grooming business. Your dog grooming business rents a building from an LLC and you own 100% of this LLC. In addition to the building, you also have several rental houses. If you set the business up correctly, you will be able to offset the income and losses from the building against the income and losses from the dog grooming business. You won't be able to offset the self-rental income and losses against income and losses from your rental houses. If you want to get around the passive loss limitations by grouping non-passive activities with passive activities, the grouping will have to make sense as a suitable economic unit. To determine if the grouping is a suitable economic unit so that the activities can be grouped together, you will use a facts and circumstances test. In addition to facts and circumstances, real estate activities have to pass a couple more tests that we will go over in a moment. While you should look at all facts and circumstances, the greatest weight in determining whether you can group your activities together is given to the similarities and differences in the types of activities grouped, the extent of common control, the extent of common ownership, geographical location, and interdependencies between the activities. Interdependencies would be things such as purchasing or selling goods between your activities. The activities normally provide products or services together. The activities have the same customers. The activities have the same employees, or the activities have a single set of accounting books and records. If you are a limited partner or limited entrepreneur, you cannot group your activity with any other activity unless it's the same type of business and it passes the facts and circumstances test. A closely held corporation can only use passive activity losses to offset passive income. It cannot use passive losses to reduce the corporation's net active income. Also, you cannot group rental real estate activities with the personal goods rental business. For the most part, outside of the self-rental regulations, a rental activity cannot be grouped with a business activity. However, you can group a rental activity with a business activity if it makes sense as a suitable economic unit and each owner has the same proportionate ownership interest in the rental activity, or the rental activity is immaterial in relation to the business activity, or the business activity is immaterial in relation to the rental activity. Normally, an IRS examiner will accept that an activity is immaterial if the activity is less than 10% of gross receipts. If you determine that you are able to group your activities, you will be able to use losses from one activity in the group against the income from other activities in the group. Once you group the activities, you have to continue grouping the activities together going forward. An IRS auditor can ungroup your activities if the auditor believes that the grouping does not fit together. So please make sure that you put a lot of thought and analysis into your groupings. If you have a short-term rental business with average stays of either 7 days or less or 30 days or less, and you materially participate in the business and you don't overly use the rental for personal use, you might be able to use rental losses to offset income from your W-2 and other income. In order to satisfy the material participation tests, spouses can combine the time that they spend on short-term rentals. Later in this video, I will give you more information about how to satisfy the material participation test. To calculate your average stay duration, you will divide the number of days that you rented out your real estate by the number of renters. If there is more than one renter during the stay, that group of renters would be counted as one renter. If the average stay is 7 days or less, your short-term rental business will be non-passive. If the average stay is 30 days or less and you want your short-term rental to be classified as non-passive, your short-term rental business will have to provide significant personal services to renters. Significant personal services include amenities such as cleaning of the rental each day while the unit is occupied by the same guest, changing bed sheets and other linens each day while the unit is occupied by the same guest, concierge services, conducting guest tours and outings, providing meals and entertainment, providing transportation, and providing other hotel-like services. If you don't rent out your short-term rental for more than 14 days during the year and you don't exceed the personal use limit, you don't even have to report your short-term rental income and expenses on your tax return. The unfortunate thing here is that companies like Airbnb, HomeAway, and VRBO are still required to issue a 1099 to you and report your short-term rental income to the IRS. The IRS has a 1099 matching program to check against your tax return to make sure that you reported the 1099 income. This means that if you decide to not report your short-term rental income under the 14 days exception, you are almost guaranteed to be questioned or audited. Speaking of audits, usually an easy audit adjustment can be made due to most taxpayers having too much personal use of their short-term rentals. Personal use of a short-term rental cannot exceed the greater of 14 days or 10% of the number of days during the year the unit rents out at its fair market value. Most taxpayers don't realize that personal use can also include family and friends. Allowing family and friends to use your rental for free or at a discounted rate will count as personal use. If you let your family or friends use your rental in exchange for you using their rental, this will also count as personal use. When you have too much personal use, your short-term rental will be classified as a passive activity instead of non-passive. If your short-term rental is classified as passive, you can try to qualify as a real estate professional to move the short-term rentals back into the non-passive category. Another way that you can have your real estate activity classified as non-passive is by being a real estate professional and materially participating in the business. If your business is anything other than a real estate activity, you only have to materially participate in your business to classify the business as non-passive. I want to take a moment here to talk about what you need to do to qualify as a real estate professional. You have to spend 750 hours a year on real estate activities and spend more than half of your working hours on real estate. Real estate activities can include things such as the time spent obtaining or improving rental real estate, managing rental real estate, and advertising for tenants. If you meet the 750 hours test, you also have to pass only one out of the 7 items on the material participation test. The good news is if one spouse qualifies for the 750 hours test, both spouses' time on rental activities count toward material participation. The bad news is that most landlords simply can't reach the 750 hours, therefore they aren't real estate professionals. If you are ever audited by the IRS and you have a manager or a management company helping you with your real estate activities, or if both you and your spouse have full-time W-2 jobs or are involved in another business full-time, an auditor will say that there is no way you are doing 750 hours. Before we take a look at how you can prove that you materially participate, I want to mention a few things that don't count toward material participation. A, unless you are involved in the day-to-day management of the activity, time spent as an investor doing things like reviewing stock charts don't count. B, time spent commuting. C, work that is not normally done by an owner. If an IRS agent thinks that the work that you did should have been assigned to an employee or contractor, the agent won't let that time count toward material participation. And D, any managerial activity that other managers don't get paid to do. So let's take a look at the 7 ways that you can prove that you materially participate. You must go through this test for each business activity or rental activity separately. 1, you participated in the activity for more than 500 hours. 2, you participated the most in the activity. This even includes more participation than a person who did not have any ownership. So this would also include managers, independent contractors, and outside services. 3, you participated in the activity for more than 100 hours during the tax year, and you participated as much as anyone else in the activity. Again, this would include anyone who did not have any ownership. 4, you participated in the activity for more than 100 hours, and you spent more than 500 hours on all your real estate or business activities combined, and you don't pass any of the other items in this list. 5, You materially participated during any 5 of the preceding 10 taxable years. The years don't have to be consecutive. 6. You materially participated in a personal service activity for any 3 years prior to the current taxable year. The years don't have to be consecutive. Personal service activities are professions such as health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, or any other business in which capital is not an income-producing factor. 7. Based on all facts and circumstances, you participated in the activity on a regular, continuous, and substantial basis during the year. If limited partners don't pass tests 1, 5, or 6, their income or loss will be considered passive. An IRS examiner will start an audit assuming that you can't prove your work hours and that someone worked more hours than you. If you have a manager, a cleaning service, a leasing agent, or a home preservation service, an examiner will carefully review the time that was spent by these workers. If you think that someone might end up spending more time than you, split that work among multiple people or companies. For instance, if you use a home preservation service, use multiple home preservation services instead of just one. If you can't provide enough documentation, an auditor might think that you did not materially participate. Please track time and activities in detail throughout the year for your employees and your contractors. If you dispose of your entire interest in an activity to an unrelated person or entity at a loss, and if it's a taxable event, you might be able to offset the losses against non-passive income. If you are disposing of an activity that was part of a group, you will not have a disposition until you get rid of all the activities or rentals in that group. So first, the capital loss from the disposal can be offset against any net income or gain from all other passive activities. Then if you have any of the capital loss from the disposal of the activity still remaining, the loss can be used to offset the capital gains that affect non-passive income. You might be able to deduct up to $3,000 on your 1040 federal tax return, and any remaining loss will be carried forward to future years. Instead of carrying forward a leftover capital loss, you should consider selling some of your stock investments that have a gain so that you can offset these gains against the leftover capital loss from the disposal of the activity. This gives you a great opportunity to sell stocks that you have been wanting to sell at a gain, but you haven't because you didn't want to increase your tax bill. Please watch the video that popped up above if you want to know more about this tax avoidance strategy. Even after you jump through all the hoops and finally get to the point where you can offset passive income against non-passive income, you will have to contend with other regulations such as the net investment income tax, depreciation recapture, and the excess business loss limitation. The excess business loss limitation is scheduled to last until the end of 2025. It was established to restrict the ability of individual taxpayers to use current year business losses to offset income from other sources, such as salaries, self-employment income, interest, dividends, and capital gains. I plan to make a video about this loss limitation, so please be sure to subscribe to catch that video. I want to take a brief moment to talk about grouping activities together. Please thoroughly analyze your situation before you group any of your activities. Oftentimes, taxpayers have been hit with an audit adjustment because when they disposed of an activity that was part of a group, they offset the gain from the sale against their passive activity loss carry forwards. This is not allowed.
No!
All of the gain on the sale would be a capital gain, and all of this gain is possibly taxable. Any losses on the activity that was sold will remain in the passive activity loss carry forward dungeon until all of the activities or rentals in the group have been sold or the group has passive income. So please make sure that the benefit of grouping will outweigh any potential pitfalls. If you anticipate that you will have passive activity losses, you might consider keeping your activities separate. This might make it easier for you to implement tax strategies to manage your passive activity losses. If you currently have passive activity loss carry forwards, here are 4 strategies you might be able to use to tap into those losses. 1. If you have another business that includes both passive and non-passive activities, you can separate those activities so you can tap into the passive income of the business. For instance, an eye doctor has passive income in which he performs eye exams and also sells eyewear, but does not materially participate in the eyewear sales. The doctor might treat the eye exam side of his business as a separate activity from the eyewear sales. Separating your activities might be a good strategy to use if you have a business with a passive activity that normally generates a profit. The goal here would be to use this passive income to offset the passive losses that you have been carrying forward from different businesses. So, you would need to split out the activities and keep separate records for each activity. You don't need to set up a new entity or anything like that. You just need to keep track separately. Then make sure to document that you don't materially participate in the passive activity. What you're saying here is, yes, I have this one business as a whole, but it has different revenue streams that are different activities. I participate materially in some, and I don't materially participate in others. 2. Sell your entire rental or activity at a gain to an unrelated party. To be able to use this strategy, you have to sell all rentals or activities that have been grouped together. So this strategy works best on rentals or activities that have not been grouped. First, you will use the capital gain from the sale to offset current and suspended passive or activity losses from the activity itself. Second, you will use any remaining gain to offset any current and suspended passive losses on other passive activities. Third, if you have any gain left after that, you can use it to absorb any capital loss carryovers on your 1040 return. After all this, if you still have any gain left over, it will be capital gain on your 1040 tax return. 3. Consider becoming a passive shareholder in a non-publicly traded business that normally has net income. Please make sure that it's a business that consistently generates net income because you don't need any more losses. You are looking to become a non-participating shareholder in an LLC, a partnership, or S corporation. Maybe you have a family member or a friend who has a business that you can invest in. You would use your passive income from this business investment to chip away at the passive activity loss carryforwards that you are trying to use. 4. If you're getting to the point of wiping out all of your passive loss carryforwards, consider strategically disposing of passive activities or rentals that are no longer generating losses. If you wipe out all of your passive activity loss carryforwards and you start generating only passive activity income each year, you might see a higher tax bill. What you really want to do is balance your passive activities just to the point of not generating passive activity income. You will receive the cash flow from the business without having the higher tax bill. Above all else, make sure that you do tax planning before you make any decisions. If you are a real estate investor and you want to know how to get an extra 20% deduction on your 1040 federal tax return through the year 2025, please watch the video on your screen. See you next time.